But let's quickly move on. It's one lender after the next. Bandhan Bank reported what looked like a bit of a weak set of numbers. The profit has declined. The margin was under pressure as well. But the question is it getting better from here on? Mr. Ratan Kumar Kesh, MD and CEO at Bandhan Bank, is with us. Mr. Kesh, thanks for joining in. That's really the question. I mean, even if you see how the stock market has interpreted your performance, it is hoping that this will not be a very prolonged asset quality issue. What can you tell us right now in terms of how you're looking at the second half, how credit costs will play out, and what you're expecting in terms of the NPL movement as well?
Very good morning to you. I think our quarterly numbers are in the context. I would say it's a decent set of numbers, and specifically on credit quality, if you see the DPD pool has inched up. We have fresh slippages at 1100 odd crores and gone up from 900 odd level. But what we see is that given the microfinance stress, and microfinance continues to be a significant part of our current book, we expect the stress to continue in Q3 as well. But given the offtake and the positive input that we are seeing in collection efficiency in October, our belief is that by Q4 it should turn it around. Therefore, if you see today on a half-yearly basis, my credit cost remains in the range of 1.8%. Our credit cost guidance of 1.8 to 2%, we are holding it as of now. And our belief is that if Q4 turns around for us, as also for the industry, we will be able to hold on to that. But we will come back with more details as we see the Q3 end and then discuss more about it.
Okay, but you said collection efficiency has improved. Can you tell us exactly how October panned out vis-a-vis September?
So you see collection efficiency for Q2 as well. For our largest constituent, which is West Bengal, we are still at 99%, which is just about 10 basis points down from Q1. And rest of the India, it has come down by 1 percentage point. But in Q3, in October, we are already seeing 50 to 70 basis point improvement in the standard pool. Of course, given that increased DPD pool that we have as of now, some of these will definitely flow through, and therefore we are not isolated from the industry. Having said that, I think we will continue to do better, and our credit cost guidance of 1.8 to 2%, we remain in that range as of now.
Okay, just that number for the standard pool, how much has it, you said 40 basis points it's improved. What is the exact number?
So we are at 98 plus to 99 range for Pan India. West Bengal continues to be very high for us, 99 plus. Even that also is improving week after week.
Okay.
Okay. Sir, just to talk about it, I mean, given the anticipated stress, you're saying credit costs are not increasing at this point in time. Provisioning is also, it was actually down slightly, almost 5% year on year, marginal increase quarter on quarter. So what can you guide in terms of, let's say, expected slippages or expected stress in terms of gross NPAs? Is there a year-end number that perhaps you can look at right now?
See, our gross NPA has gone up from 4.2 to 4.5 already. And our belief is that the slippages will be a bit more elevated in Q3. But with Q4 and some treatment that we expect to do, we will maintain in the range of 3.5 to 4% by end of the year as a gross NPA. Now, while on the microfinance segment, there are a bit of a stress, but I want to just decode that a little bit more specifically for our bank. You see, overall pool that I have based on the latest scrub, Bandhan, unique to Bandhan Bank customer in the microfinance side is roughly around 60%. Bandhan plus 1 is 80%, and Bandhan plus 4 and above, which is to me the most stressful segment for us, is just about 4.5%. So while I would at one point I would say we are not isolated, given the elevated stress in the industry, we will be impacted. But but given the guardrails that we have been taking over the last 18 months or so, whole bunch of steps that we've been taking, we've been growing moderately over the last years, whereas probably the industry was growing significantly, and some of these would have reflected into overrating and over leveraging. I would say we will still be better than the rest of the lot, and headline gross NPA we will we have some thoughts in mind. We will try and maintain it in the range of 4 to 4.5 at the end of the year.
Well, Sir Abhishek, this side, you had a strong deposit growth in this quarter, 7% sequential growth. Could you guide with respect to, what was the incremental cost of funds that you got in this quarter? Because your net interest margin dipped by 20 basis points on a sequential basis. And would you continue to look at deposit growth at this level to bring down your overall credit to deposit ratio? So any guidance on CD ratio that you are looking by the end of FY25?
You can give guidance on CD.
I think as we've been demonstrating quarter on quarter strong ability to garner deposits. Our deposits have grown by 27%, and quarter on quarter it has gone up by 7%. Yes, there has been a bit of a stress in the liquidity, there's intense competition in the market, but our ability to garner deposits through the franchises that we have built, 1,700 plus branches, after core transformation, some of the products that we have launched, and many more products are actually coming on the transaction banking side. So some of these coming through, some of the old branches we are re-energizing, the separate sales team created. I think our ability to garner deposits will continue to be up. Our guidance is that we will grow our advances at 18% plus minus 1, and deposit will grow faster than that. Therefore, CD ratio will continue to keep coming down. We are not giving a guidance at this stage given the overall macro. But I think we will stay definitely in the range of below 90% as of by end of this year.
Just one number, NIMs, net interest margin.
So net interest margin, see this quarter also we have delivered like 7.4% down from 7.6. But if you have to look back 1 year back, it has gone up from 7.2 to 7.4. Our view is that whatever happens, our cost of fund obviously has gone up. It has gone to almost 7%.
No, sir, we are running out of time, Mr. Kesh. I just wanted a guidance.
Guidance is 7 to 7.5.
Okay, that larger range. Thank you very much, Mr. Kesh. We will invite you yet again when we have more time. The market, of course, has given a thumbs up in terms of stock price, but that's because Bandhan took a huge beating after the indecent numbers.
Cheap valuations.
And that's,
valuations are cheap.
Yeah, and it could also be, but it could be just short covering because it was already sold off.